Hey folks, imagine this. You're scrolling through your feed, sipping your morning joe, and bam, the news hits that the US dollar, that rock-solid king of currencies you've always taken for granted, is starting to wobble like a house of cards in a stiff breeze. But here's the kicker. While everyone's freaking out about crypto crashes or stock market dips, there's this ancient shiny metal quietly stepping into the shadows, ready to call the shots. What if I told you that gold, yeah, that stuff your grandpa buried in the backyard just in case, is gearing up to become the unofficial backup plan for the world's money by 2027. It's not some conspiracy theory cooked up in a basement. It's happening right under our noses, with central banks hoarding it like squirrels prepping for winter. But why now? What's the big mystery driving this gold rush among the bigwigs who control our cash? Stick around, because we're about to dive deep into a story that's equal parts history lesson and wake-up call. By the end, you might just rethink where you're stashing your savings. Alright, let's set the stage here. To understand why gold's making this comeback as a shadow currency, that reliable sidekick lurking in the background when the main star falters, we got to rewind the clock. Gold's been humanity's go-to for value since way back when. Think ancient Egyptians decking out pharaohs in bling, or Roman emperors minting coins that could buy you a villa. It wasn't just pretty, it was practical, rare, durable, and nobody could fake it as it lee. Fast forward to the 19th century, and bam, the gold standard becomes the real deal. Countries like Britain in 1821 and the US in 1834 pegged their paper money straight to gold. You could walk into a bank and swap your bucks for actual gold coins or bars. It kept things stable. Folks, inflation stayed low because governments couldn't just print money willy-nilly without the yellow stuff to back it up. But here's where it gets juicy. Enter the big players, the central banks. These are the folks pulling the strings on national currencies, like the Federal Reserve in the US or the People's Bank of China. Back in the day, they stockpiled gold to maintain trust in their money. Key figures. Think John Maynard Keynes, the economist who called the gold standard a barbarous relic, but still recognized its power, or Winston Churchill, who reinstated it in Britain in 1925, only to watch it flop during the Great Depression. The system promised stability, but it had cracks, wars, and economic busts forced countries to bend the rules. Tease alert. What if those cracks never really healed? What if they're widening right now, leading to a crisis that's got central banks scrambling for gold, like it est Black Friday at the vault? We'll get there, but first, let's trace this tale step by step, cause and effect, to see how we ended up on the brink. Let's kick off with the origins. Gold's role as money. It goes back millennia, but the modern gold standard kicked into high gear in the 1800s. Cause industrial revolutions cranked up trade, and folks needed a universal yardstick for value. Effect, by 1879, most major economies were on it, the US officially in 1900 under the Gold Standard Act. Prices stayed steady. A dollar bought roughly the same basket of goods for decades. No wild inflation spikes because supply was limited by how much gold miners could dig up. But origins have shadows. The system favored gold-rich nations, and when shortages hit, economies tanked. Enter World War I in 1914. Governments ditched gold to print money for tanks and troops. Cause war demands outstripped reserves. Effect, hyperinflation in places like Germany, where folks wheeled barrows of cash to buy bread. Post-war, they tried patching it up, but the seeds of doubt were sown. Now, the rise post-World War II. The world was a mess, economies in ruins. Enter the Bretton Woods Conference in 1944, where 44 nations led by the US and key figures like Harry Dexter White and Keynes hammered out a new system. Course need for global stability to rebuild. Effect, the US dollar became the world's reserve currency, backed by gold at $35 an ounce. Other countries pegged their currencies to the dollar, and Uncle Sam promised to convert dollars to gold for foreign governments. It was a golden era. Pun intended. Trade boomed, the middle class grew, and the US economy roared like a muscle car. Central banks accumulated gold as a safety net, but the dollar was the star. By the 1950s and 60s, America was spending big on the Cold War and Great Society programs. Tease. But what happens when the party host starts running out of drinks? The system was cruising toward a cliff, and nobody saw it coming, or did they? Boom. The breaking point. By the late 1960s, Vietnam War costs and domestic spending had the US printing dollars like confetti. Cause, balance of payments deficits. Foreigners cashed in dollars for gold, draining US reserves from 20,000 tons in 1952 under 9,000 by 1971. Effect: gold prices spiked on open markets, hitting $40 plus while the official rate lagged. Enter President Richard Nixon on August 15, 1971. The Nixon Shock slammed the gold window shut, ending convertibility. No more swapping dollars for gold. Why? To prevent a run on Fort Knox, folks. It was the death knell for Bretton Woods. Cause: unchecked spending met finite gold. Effect: the world shifted to fiat currencies, money backed by nothing but government say-so. Inflation: it went bananas, hitting double digits in the U.S. by the 1970s. The fallout was brutal. Without gold's anchor, currencies floated wildly. Cause: oil shocks in 1973 and 1979 from OPEC embargoes. Effect: stagflation, high inflation plus stagnant growth. Unemployment soared, folks lined up for gas, and trust in paper money tanked. Central banks, they sold gold initially, thinking fiat was the future. But prices crashed in the 1980s as rates hiked under Fed Chair Paul Volcker. He jacked interest rates to 20% to crush inflation. Cause: tight money policy. Effect: recession in 1982, but inflation dropped from 13% to 3%. Seemed like a fix, but it was temporary. Debt ballooned. U.S. national debt tripled in the 1980s. Fast forward to 2008 financial crisis. Banks collapsed, governments bailed out with trillions in printed money via quantitative easing. Cause: subprime mess. Effect: more debt, low rates and inflation lurking. COVID in 2020. Same playbook. Stimulus checks galore, debt skyrocketing. But here's the rub: those fixes, they failed long-term. Volcker's hike worked short-term, but set the stage for debt addiction. Key: after 2008 propped up markets but inflated assets, widening inequality. Cause: easy money. Effect: bubbles in stocks, real estate. By 2022, inflation hit 9% in the U.S., forcing rate hikes that nearly tipped us into recession. Failed fixes piled up. Austerity in Europe post-2008 led to populism. Japan's endless QE trapped them in deflation. Central banks tried digital tweaks like CBDCs, but nothing addressed the root: unlimited printing without backing. So, if history's any guide, what's the next chapter? Could gold be sneaking back as the fix that actually works? Now, let's connect these dots to today, and boy, the parallels are eerie. Just like the 1960s build-up to Nixon's shock, we're seeing unchecked spending and eroding trust. U.S. national debt. As of late 2025, it's blown past $38 trillion. That's over $100,000 per citizen, folks. Cause: pandemic bailouts, wars, entitlements. Effect: interest payments alone gobble $1 trillion yearly, more than defense spending. Inflation, officially down to 2 to 3%. But folks at the grocery store know it's sneaky. Food and energy up 20 to 30% since 2020. Shocking data. The Congressional Budget Office projects debt hitting 118% of GDP by 2035. But with Trump-era policies lingering, it could spike sooner. Enter central banks, the real MVPs in this story. Remember how they sold gold post-1971? Flip the script. Since 2022, they've been net buyers big time. World Gold Council data. Over 1,000 tons accumulated annually from 2022 to 2024, up from 400 to 500 tons pre-pandemic. In 2025's first half, 415 tons, down a bit, but October alone saw 53 tons snapped up. China, leading the pack with over 2,000 tons added since 2010, now holding 2,300 plus tons. Russia, India, Turkey, all in on gold. Shocking fact: by 2025, central banks hold more gold reserves than U.S. Treasuries for the first time in decades. Per IMF data, gold's share of global reserves at 18%, up from mid-2010s lows. Why? Geopolitics, baby. Sanctions on Russia post-Ukraine froze dollar assets. So BRICS nations, Brazil, Russia, India, China, South Africa, now expanded, are ditching dollars. Cause de-dollarization push. Effect: BRICS controls 42% of global FX reserves, trading in local currencies and eyeing a gold-backed system. Patterns repeating, you bet. Just like pre-1971 deficits drained U.S. gold, today's U.S. debt, projected to add $2 trillion yearly, erodes dollar dominance. BRICS talks of a blockchain payment system that's code for bypassing SWIFT, the dollar's lifeline. Shocking projections say gold prices could double to $5,000 plus by 2027 per investing haven, fueled by this hoarding. World Bank sees peaks in 2026 before a dip in 2027, but if crisis hits, all bets off. JP Morgan forecasts new highs through 2026. Modern twist, crypto's volatile. So gold's the steady eddy. Central banks cite geopolitical risk in surveys to 70% plan more buys. It's like the 1930s Depression redux, when countries hoarded gold amid uncertainty. But hold on, why shadow currency by 2027? Projections paint a picture. If US debt spirals, inflation reignites or BRICS launches a gold-tied currency, gold becomes the de facto benchmark, not overt, but shadowing trades, reserves, even settlements. Shocking data. BRICS holds 20% of world gold, per Nesment, enough to challenge the dollar. Patterns. History shows when fiat falters Weimar, Zimbabwe, gold shines. Today's looming crisis, high debt meets AI-driven job losses, climate costs, recipe for turmoil. All right, let's wrap this up with 3 clear takeaways, folks. First, diversify like your future depends on it. Gold as a hedge against inflation and dollar dips. No-brainer if you're eyeing retirement. Second, keep tabs on central banks. Their gold grabs are the canary in the coal mine for global shifts. Third, understand history's cycles. We're repeating patterns, but with tools like gold, you can break the chain. Warning, by 2027, if de-dollarization accelerates and US debt hits critical mass, we could see a crisis that makes 2008 look like a picnic. Or maybe not, but ignoring the signs. That's playing with fire. If this got your wheels turning, hit that like button. Subscribe for more deep dives on finance's wild side, and drop a comment. What's your take on gold's comeback? Share your thoughts below. Thanks for watching. Stay savvy out there.